the reality of inflation beginning to get priced into these markets. Mohamed El-Erian describing it as potentially one of the worst Fed inflation calls ever. Agree or disagree?
I'm not sure I disagree or agree. This is a new experiment. We haven't been here before. In terms of just the reaction function of the Fed post-COVID, obviously the Fed seem to have done the right thing. They've actually saved the market in many ways, equity market, financial markets, in terms of pushing in liquidity in the market. Now, to come out and say, to criticize the Fed post-facto and say, well, listen, you guys got it wrong here, I think is a bit premature. I think the Fed has a very clear target. They've made their purpose very clear. They have a 2% inflation target. They're going to achieve it. It looks like this is going to be on the books next year. I think they're right on track to what they've said they're going to do.
So you think this is going to be transitory and you don't see the Fed as being behind the curve?
I think the Fed's been very clear. If we listen to the Fed members, they intend to let inflation run hot to retain the 2% inflation rate. I mean, historically, the Fed struggled to hit that inflation rate, much like the ECB and the BOJ, for example. I think the Fed really intends to let inflation run hot in the short term and then actually begin to lift off in midsummer of next year. The point being is that we still don't know. We're still talking about COVID effects in Europe and the US potentially over the next few months, and that's simply untangible. We don't know the effects and that there is the Fed response function to COVID and the slowdown. No, I think that the main issue here is it going to be growth-led inflation, or is it going to be simply liquidity-led inflation? And I think that's really where the mark is at between critics of the Fed. I think we're heading towards more of a growth-led inflation, which is a much better setup for the Fed for liftoff in summer.
From a technical and fundamental perspective, there's a lot that speaks to buying the dollar. Is this a good time to do that?
I think, again, the dollar has been very clear. There is a clear demarcation in terms of what the ECB and the Fed and the rest of the central banks are doing. The Fed is ahead of the curve in terms of their inflation outlook in achieving inflation. The ECB right now and the rest of the central banks are still in wait and see mode. I think what we will see is the differential between U.S. and European debt and global debt actually widen more as inflation expectations rise, especially if we begin to see more optimism towards a growth-led inflation. We could see the back end in 10-year significantly move back up towards the 2% mark. I think that will drive more dollar purchases.
What about equities? Here's a chart that caught my eye. I want to share this with our global audience. GTV Go for the details. This is your S&P 500 earnings yields that are set at record lows. Basically, after adjusting for inflation, the real earnings yield for the S&P 500 at about negative 2%. I mean, where do you find then positive real yield if it's not going to be on the S&P 500? It's shocking.
But I think once again, we're looking at a transitory phase in terms of asset allocation. Where else do you go right now besides equities? It's a hard sell. Obviously, equities have been an pseudo-inflation hedge rather than gold over the past 15 months, and I think that continues until we actually see Q1 pass, when we actually begin to see and project what if the Fed's going to be a one hike of 25 basis points or 50 basis points in summer or late summer. I think that's when we begin to see equities perhaps take a step back. Again, we have two stories. We have the Powell story. Is he going to be renominated? Is that going to change the policy of the Fed? I think Powell re-entering will probably tilt the market towards a more hawkish stance as we move towards capping inflation in the short term. Again, obviously, there's a bit of a surprise in terms of the inflation being as high as it has historically, given that the Fed has failed to hit targets previously. But I think we're on the right track in terms of what the Fed mandate is right now.
What about another term for Jay Powell? I mean, he is being put to the test with contender, Ms. Brainerd. How do you think this is going to end eventually?
Look, there's no right or wrong way of saying it. I mean, obviously, Brainerd actually fits the Democratic profile in terms of what who they would like to see in the Fed. At the same time, I think Powell's been understood by the markets. This is not a time to change the Fed chairman. And I think right now what we're looking at is, especially since President Biden's last comments regarding inflation, I think that most likely Powell will be renominated unless there's a massive shift in terms of inflation targeting.
Is it too soon to expect any immediate breakthroughs in what is a very tenuous relationship between the U.S. and China?
Once again, we were talking about basically semantics in terms of China and the U.S. Obviously, right now, we're seeing a shift in terms of policy, at least the discussions post the Trump presidency. I think now we're seeing a bit more progressive movement from the U.S. administration to actually meet Chinese halfway. I think that over the next few weeks and months, we'll see better ties in terms of trade relationships. Obviously, the previous administration had a much more harsh approach to the Chinese. And I think at this phase, Biden needs the Chinese to soften their tone a bit. Obviously, inflows into the U.S. of Chinese investments still matter. And I think this will still be a key point. Obviously, the recent tensions with the Chinese military, obviously the media has been making a big deal about it, have to be allayed a bit. And again, it's from both sides. It's Xi making a run for a new term. It's Biden keeping the hawks at bay in his own administration.
And what about domestic monetary and fiscal policy? Growth is beginning to get a bit wobbly, to say the least. Is this the time to step in more aggressively? Do you expect them to do that? And how do you trade on that?
Again, ever since the Evergrande story, the market has been very negative in terms of the short-term implications to China. Obviously, the Chinese authorities have actually dealt with this, and I do believe this is more of a manufactured slowdown in terms of slowing things down in China to a level where basically it is more in line with the G7 and G10 to speak. Over the medium term, I think China will recover. Obviously, we will still remain pressured in terms of credit, in terms of the real estate market. This is going to be a phase that could last for 2-3 more quarters until China's supply side begins to actually open up again. Obviously, China's has the wild card here into next year will effectively be, will Chinese supply side begin to be a counter to U.S. inflation? I think that's something to keep an eye on as shipping lines open up and as supply constraints begin to loosen up. I think that could be a major element in next year's numbers.
So do you have any preference then in China equities? Is it tech? Is it maybe some of the oversold banks and insurance names?
But for the short term, I think right now you have to actually keep buying and dip strategically in China. Looking for a 6 months to 1 year horizon is a bit tight. But I think right now you have to definitely try to step back from real estate and actually look more for financials and tech. I think that's still the play in the short term. Try to move a bit more into blue chips as we see a filtering out of the smaller firms in terms of China. You can't behave the same way as you've behaved in the past 5 years where you've seen cross buying Chinese assets. I think you have to be a lot more selective in terms of credit quality that you're buying into now.